For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and I'm just here to ask the questions with the words of wisdom and solid advice. Well, of course, they come from Randy and Jake Floyd of Floyd Financial Group. Start with you, Randy. How you doing this fine mid-September morning?
Doing very well, Jeff. How about you?
I'm doing great, thank you. Mid-September here. Let's turn to you, Jake. How are you, my friend?
I'm just glad that we're another week closer to this election being over with.
Yeah, are you kidding? This has been one of the most anticipated elections ever. But it won't be too much longer. What do we got? Maybe a month and a half, something like that? And then probably we still won't know who's going to be president. I think you said that this will probably be debated. Whichever party does not win will challenge it, and we may not find out who's president until a month or so after this. What do you think?
I don't know. I think it's going to be too big to rig.
I hope so.
I hope so, too. I couldn't take another one of those disputed elections, but nevertheless, all is well when we're here on the radio talking to fine people here, the last bastion of sanity, Springfield, Missouri. And Randy and Jake, we've got a lot to talk about on the radio program today, so let's get started with some current events. First of all, we'll start with the old standby, and that is the market. What's your take on the market these days?
Well, Jeff, I think that the market, has been very volatile here of late, which really is to be anticipated with all that is going on in the world right now with the election and everything. But also, we're seeing, that unemployment is headed up. There's been more or less jobs created, and we know that Jerome Powell is probably going to cut rates. I say probably. He's going to cut. We just don't know yet if it's 25 or 50 basis points. And so the market's kind of trying to price that in and figure out what he's going to do. And so that's why it's been a little crazy here of late. Plus, we did have a few companies that were a little tight, missed some earnings, and didn't really produce what people were looking for. So that's why we've had some volatility. But make no mistake, we're still very close to the high. And we're way up over 52 weeks, probably north of 30% still, even with this downturn.
Well, do you think that there's anything really that can stop the market, that can really throw a monkey wrench into things?
Well, yeah, let's see, Harris, probably.
Okay, spell it out for us here. Come on.
Yeah, there's some things. First of all, here we are in September, which is notoriously, not the best month for the market anyway. Then we're coming up on October, which notoriously is pretty good, But I think everybody's kind of hanging out, watching the Fed funds rate, and they're also wanting to see what's going to happen with this election because there's some key issues, on taxes and taxation of capital gains and, all that sort of thing that are really crucial. And then I think, just policies in general, because, business likes certainty. And right now, we're pretty uncertain, right?
Absolutely. Well, as you said, businesses like certainty, and this is one of the most uncertain Septembers that I can remember in recent memory. So, again, it's one of those things where we'll just have to wait and see. But I think a lot of this depends on what happens in early November here with the presidential race. So I would imagine that you as planners, tell me if I'm wrong about this, do you have maybe a different strategy depending upon who gets into the White House?
Oh, absolutely. I mean, we're going to be watching. In fact, I told some people this just a few days ago. We were sitting there, and they said, "So, if things really go ugly, what do you guys do?"
Yeah.
So I said, "Well, we are always looking at everything and how it's moving and shaking out there from stock market. You got the market, you got commodities, you got bonds, you got real estate, you got all these things, interest rates. All these things are playing into what we do, and so when we get dealt lemons." We have to figure out where do we get really good water and sugar and make the best lemonade possible.
Yeah, sure.
So that's really what it's about, is really sticking our head kind of above everything and looking around and saying, okay, that looks less messy over there than what that over there does, and that might hold some opportunity for us. And so there's always money being made somewhere. Mm-hmm. We just have to be sure that we're watching and looking for where the next spot is.
I have given a lot of thought to what we buy in either scenario. There's different types of products that work in different types of environments, but there's also different types of stocks that would work under Harris versus Trump. Rest assured that by the time that day comes, there will be thousands of hours of consideration as to what we're going to do. And so it's definitely not something we're going to wait till the last minute to think about. It's something I've been thinking about for a year, which is part of the reason why I'm going to be glad when this election cycle is over. And, if you've been listening to this show, or if you're a client of ours, or if you've been in to see me, you'll know that I've been talking about this election pretty much nonstop for the last 18 months or so, and I'm about ready for it to be over with, one way or another, to be honest.
Sure.
It is the elephant in the room, so we must talk about it, but it's not going to hurt my feelings, in January or whenever this all gets settled, when I don't have to talk about it anymore, and we can kind of go back to some state of normalcy.
Okay, so that's what's happening in the market these days. What does the bond market look like?
Well, Jeff, for a long time we had really low interest rates in the bond market. 10-year Treasury bills were down around 1%, 1.5%. And then, of course, we had March of 22, we had Jerome Powell come along and start raising interest rates. And so it got to where short-term interest rates were paying more than longer-term interest rates. And so with that happening, bonds became really not a very good investment, because as rates go up, it devalues the bonds that you currently have. It's called a market value adjustment, basically based on interest rates. Now what we're seeing as Jerome Powell starts to get ready to take interest rates down, there are some bonds out there that we're holding that are going to start to appreciate. Now, you always get the interest payment as long as you hold the bond, right? Whatever that payment was when you took it out, the coupon rate or the nominal rate. Right. So beyond that, though, as interest rates start to come back down, we're going to see bonds start to appreciate in value. So there's going to be a changing of the guard here as we see interest rates start to come down. So bonds and the 60-40 portfolio is just about back in style and in a good position, whereas for the last 2.5, 3 years, the 60-40 portfolio was basically a dead duck.
Talking with Randy and Jake Floyd of Floyd Financial Group, talking about current events. We've talked about the market. We've talked about bonds. What about the Fed funds rate? What's happening with that?
Yeah, so Jerome is getting ready to tell us what he's going to be doing. And again, it's the thing that we know that he's probably going to relax it. We just don't know if it's going to be 25 or 50 basis points. And really what that points to, and the reason that's important for us to keep tabs on, and we'll talk more about this in another segment, but bank CDs, money market accounts, all those things are getting ready to change drastically, where people have been happy for the last couple of years, 2.5 years, I guess, since he started raising interest rates. Now it's going to start going the other direction, and so it'll be something that mortgages will start to look better, which will probably push housing prices. But bank CDs and money markets, those days are numbered as to where you're going to want them.
Randy, you think we're looking at 50 or 25?
Yeah.
50.
50.
He's thinking 50. So I think it's going to be 25, but mainly because of ego. Because if they say 50, they have to admit that they're behind again. Mm-hmm. I think they'll do 25 because they don't want to admit that, although I think they probably should do 50 or maybe even 75, in my opinion, as the labor market is weakening, which is their primary thing they've been watching from inflation and then full employment standpoint.
So you're thinking he might surprise us and come out and say, okay, I'm going to go 25 bips, and then he'll do a one-off like he did a few years ago and come back and say, oh, by the way, I know it's not been 6 weeks, but I'm going to go ahead and go to the 25.
I think if it starts to look like we might get Harris, we might see a lot of gushing in the stock market. If the stock market really starts to evaporate and we're down 10%, 12% over the next few weeks, yeah, I think there's definitely runway for him to come out and say, let's do 50 or 75 or a full point just to get it down faster. I think most of that will be dependent on what's going on with banks and bank liquidity as that happens. And so I think there's runway for that, but I do think that this initial move in 4 days here is going to be 25 to save face.
Well, a lot of people don't realize, I think, Jake, that some of the bank liquidity issues were actually caused by the rapid rate increase since March of 22 through the end of 22 and then partially 23. Because as you push rates up fast like that and people come to the bank and say, hey, I want my money, I mean, that creates a liquidity crunch. We're probably, if he goes too fast, though, on this other side, we would have a liquidity crunch again in the opposite direction.
Right, and I think that's why he would come out and potentially do a full percent cut or something, because that would largely fix the issue that the banks would be having if they're having any kind of an issue. I don't think banks are going to have big trouble as we go back. Now, bank stock prices is a different story, and we can circle back to that if we want to. But as far as your ability as a person to get money out of the bank, I don't think there's going to be an issue there. And the reason for that is 18 months ago when we had these first three bank failures of Signature Bank and Silicon Valley Bank and First Republic Bank, the Fed pulled out $300 billion worth of liquidity over a weekend to fix that problem, which is, as I've related before, roughly like pulling out a bazooka to take out the ant in the corner. And so they have no intention of letting there be a liquidity crisis in the bank. They'll do whatever's necessary to fix it. So I do feel pretty confident in that, but that won't stop bank stock prices from getting cut in half if they if there's really a scare.
Right, and it will be harder for banks to make their profit numbers in a sliding market because they've got the pressure of that sliding market, and unless they put loans out there that have early payoff, which is almost impossible to get people to buy anymore, early payoff features, people will be in and out of those and switching and running from bank to bank to bank as rates fall.
We're talking with Randy and Jake Floyd of Floyd Financial Group. We're talking about current events. We've talked about the stock market, the bond market, also the fact that we're going to be having an interest rate cut here, hopefully in about 4 days or so. If you've got questions about anything that we talked about today, you're wondering how the market, how the economy, how this presidential election will affect you and your portfolio, well, I've got some good news for you. We're offering a Floyd Financial Group look at your retirement plan at no cost and no obligation. How do you get yours? Call 417-889-7233. You can make that call this weekend. All you've got to do is leave your name and telephone number. Ashley will get that and call you back during the week and set up an appointment that is convenient for you. So don't let the weekend stop you. 417-889-7233. Get your Floyd Financial Group casual conversation going. And remember, this one call could make all the difference. We're going to take a break, Randy and Jake. When we come back here on Show Me the Money, we'll be talking about why interest rates are so important. When Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about, Jake, why are these stinking interest rates so important?
Randy, I don't know. Why don't you enlighten us?
Okay, well, maybe I will.
That's right. Well, why don't you enlighten all of us while we're talking about it here? People talk about interest rates so much, and they apply to us, of course. Credit card interest rates, very, very high, nearly 30%. Of course, interest rates on things like loans, auto loans, that sort of thing. And then there are the interest rates on everything else, mortgages included. So why are interest rates so important? Now, I was talking about things that you buy, but also as far as investments go.
Yeah, for sure. So when we go out and we look at situations in life, if we aren't careful, we only see it through our lens. In other words, our perspective and how we look at it. I've often thought about this over the years. We're all part of what we call a cohort, right? Now, none of us like to be grouped in and say, well, you're all the same, stereotyped. But believe it or not, we are part of a cohort. Of course, birth-wise, a lot of us are baby boomers, right? A lot of us retired people today. Right. And then the Gen Xers, and then the Gen Z or millennials, and then the Gen Zers and all those things. But when we really look at this and we look at interest rates, it goes across every spectrum of the economy. So, and you alluded to it just a little bit. Number one, first and foremost, as rates come down, people are going to see the first impact will be, and you're already seeing this over the last few weeks prior to this rate cut that we know is coming. We have seen banks pull their horns back and not be willing to pay as much interest on money market accounts and CDs. And also shortening the terms to 5 and 6 months from a year and 14 months that you could get it as little as a year ago. So why is that? Well, they know there's two places for banks to get money. One is they get it from the Federal Reserve, or they get it from you and I as depositors, right? So they know that the Fed funds rate is going to come down. The banks have already got this priced in. And so they know that's happening, and so they don't want to pay anybody long-term a rate of 4.5%, 5% when they know they can probably get it from the Fed down the road for 3% and be hung doing that. Then they won't be competitive in the marketplace. So that's really one of the reasons. The first thing is bank money markets and CDs will start to come down. We're also seeing, just due to the pressure they know is coming, we're starting to see mortgage rates go down where they were 7. Now I think we've been seeing 6.25%, 6.5%, maybe even some 6% stuff out there. So that's the second thing that we're starting to see. Now, all that translates to what? It's kind of an offset, if you will. So if I have money invested at 5 or 5.25 right now, and I'm paying a 7% mortgage, but all of a sudden, as rates come down, I'm going to be able to now get a 6% mortgage, but I'm only going to get 3 or 4 on my savings. It's kind of an offsetting event, right?
Right.
So there's positives and there's negatives on both sides. So for retirees, they've been going, yay, I love these 5.25 CDs, guaranteed rates on my money. Though this is awesome, right? Versus where we were a few years ago, where if you had $1 million, you could get $10,000 a year, or maybe $5,000 a year on your money markets and CDs. Now you're getting $50,000 a year. So as these things start to change, it's going to help some people with buying things, but it's also going to hurt some people with buying things. People that don't have mortgages and things that are looking to have savings invested in banks and that sort of thing. It also affects the stock market, because as people see that rates are coming down, they're not going to be able to earn as much as they've gotten used to now in their bank CDs. They're going to be headed back to the market, and that's going to help push prices back there.
The Tina trade.
Yeah, there is no alternative, right? So the other thing that we have not talked about is the cost to business. So the prime rate, a lot of people don't really know what that is. They've heard it before, and they know, well, yeah, the prime rate. Well, the prime rate is basically what banks lend money to. That's the cost of money to their best customers. So right now, the prime rate is 8.5%. Well, as little as 5 years ago, it was 3.75%. So a lot of companies have to borrow money to meet payroll, and as they're expanding and trying to grow business and do advertising and buy new buildings, when they have to borrow money at 8.5% versus 3.75%, that really changes what their expense load is that they have to produce each month. And a lot of folks, may be thinking that these companies are making 50% profit and 25% profit. Bottom lines for most publicly traded companies are somewhere between probably 2 and maybe 7%. Walmart probably sitting in there, what, Jake? I haven't looked at it for a while, maybe 2%.
Yeah, maybe as much as 3, but yeah.
The cost of borrowing to do these things for business is crucial, and it really affects how they're able to operate.
Well, you were talking about why interest rates are so important as far as the mortgage market goes, and I've been sort of in the market for a home, and, when I go to Realtor.com, it's now plugging in sub 6% interest rates, but you're saying they're 6.25%. Are they really just looking ahead to what they think things are going to be?
Yeah, I think they absolutely are, and trying to maintain, if you will. I mean, it's been a very competitive market with fewer buyers here of late. So the mortgage applications are down is what we've been seeing. So right now they're vying for position.
You mark my words, if we see a sub 5% mortgage rate, this housing market is going to explode upwards. You're going to see refinances go up 10x. It's going to be wild and crazy. Yeah. And people will pay off all this 30% credit card debt that they have, and this economy will be ready to run again. And again, I'm not advocating that we run up debt. I'm just simply saying it is the American way to buy things that one cannot afford. And right now, people can't afford to keep doing that because they're maxed out on a lot of their credit cards.
Well,
so as soon as they have the runway to do it, they will refinance and they will go again.
Yes, they will. And I will tell you, too, there's a lot of people in the appraisal and mortgage business that have been out of work here of late.
Yeah.
They have lost their positions. So now, all of a sudden, it's going to be popular again to be a mortgage broker. These rates go down. And like you said, there's this massive refinance because, let's face it, if we get interest rates to 5% and we've got all these people the last couple of years that bought at 7%, well, 2% on a $400,000 house, is $8,000 a year in interest.
Yep, it is. I know. I plugged it into those calculators, and you're right. You can see a tremendous
$700
difference.
a month.
Yeah. Oh, yeah. I saw $600 a month last night, and one of the things I was looking at. Mortgage rates will dictate the value of a home. People are like, well, my home's worth $450,000. Well, maybe it was when interest rates were so low and they were 3%. But really, when interest rates go up, the value of your property can go down, right?
Absolutely. So, I mean, it's really, again, we're just kind of pointing out why interest rates are so important here. The other thing is we got to realize, we've talked about this a little bit, it is also a translation to everyday prices. Again, as these companies have to spend more, they have to make more. So they've had to spend more because they have interest on that money, for maybe to raise inventory or to build a new building or whatever, to expand their business. They also had to have more money, more cash flow to pay their employees more as wages have spiked. So as rates come down, it's going to affect all of these things. And, the other thing that we haven't even talked about is what if interest rates come way down? And the other thing we haven't talked about is what if oil, because we get to drill again, comes way down? We're now going to have more downward pressure on inflationary pressures and things. So things could really get good. The one thing also that we haven't talked about here is this thing called a market value adjustment. Now, that's kind of a very technical sounding term. But what it amounts to is the reason bonds are going to come back into favor is as these rates are pushed down, any existing bond that you have that pays more than the current Fed funds rate is going to be appreciating in value as those people that are still looking for safety are out there. They'll always be with us. There's always people that are CD investors. There's always people that are bond investors, even when markets are fundamentally really great and growing. So the market value adjustments of assets that people are holding in safe assets are going to change and will be elevated.
We're talking with Randy and Jake Floyd Financial Group. We're talking about why interest rates are so important. So the bottom line, what I've taken from the conversation, Randy and Jake, is that interest rates will affect you positively as an investor. They'll also affect you positively as a buyer if they do come down. But high interest rates are good for us if we're investing, not so good when we're buying things. So with that in mind, again, we don't have a crystal ball. You've got one. I sent it to you, but it doesn't work. Where are we seeing, let's say, at the end of this year and then in 2025, if we could forecast based on the information that we have right now, which is not a lot, where are we seeing interest rates go in the coming year? And should this equation stop us from really doing anything, buying or investing?
Yeah, that's a good question. So I think people say you're never supposed to talk about, politics and religion. Well, that's hard to avoid.
Yeah, bring it on.
we're gonna talk about politics here a little bit.
All right.
So depending on who gets elected and how that plays out is going to determine a lot of this. And while the Fed is supposed to be independent of, political pressure and the president and Congress, I think that we could see interest rates come way down for two reasons. Number one, there will be pressure from the Trump administration to do so if he gets elected. Harris, not so much probably. So the other thing is we have a lot of debt out there, the 35 or so trillion that we have. Guess who owns most of that debt?
Yeah.
The American public. So right now, the federal government is in a position to where if they refinance debt right now, they're having to refinance it at 5%. They can't afford that, and we can't afford that because guess who they have to tax and borrow more from to pay the interest?
Yeah.
You and me.
That's right.
So it's kind of like people that forget to take money out of their large IRA withdrawal, and then it comes around next year at tax time, and they have to withdraw what the tax is plus that much more to pay the tax.
Yep.
And interest is a tax on us
Right.
on this debt. Make no mistake.
Yeah.
And so that's why interest rates, I believe, have to come down long term as we refinance debt.
Great conversation, Randy and Jake, about why interest rates are so important as an investor and a buyer. And again, based on our conversation, I'm sure that our listeners may have some questions about how it can affect you. If that is you, give us a call here at Floyd Financial Group and sit down with Randy and Jake and talk about your journey towards confident retirement. You can get this conversation started at no cost, no obligation whatsoever by calling 417-889-7233. I know it's the weekend. It is Saturday morning, but make that call. It's going to take you about a minute to do that. Leave your name, telephone number. Ashley will call you back during the week, and you can get in and sit down with Randy and or Jake at Floyd Financial Group and have this casual conversation about your journey towards a confident retirement. Again, no cost, no obligation for this. 417-889-7233 is our telephone number. You could also request your appointment. Find out more about us online at floydfinancialgroup.com. Time for a break, Randy and Jake. When we come back, we'll be talking about how long will $250,000 last in retirement. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about how long will $250,000 last in retirement?
And this is a good question, and I think really the definitive answer is it depends upon your lifestyle. But you spend $500,000 a year, lasts you about 6 months or so. But I think that's not most of the people listening to us here in the last bastion of sanity. So if $1 million will afford you a comfortable retirement, how far would $250,000 go? Well, it might surprise you to find out that you can make $250,000 last for decades in retirement. So let's start there. I come into you, Randy, Jake, and I say, boys, this is what I've got. I've worked my whole life, and I've been, frugal, but still I've only got $250,000 in retirement. Let's say that I'm 65 years of age. Where do we go from there to make this stretch?
Yeah, that's a great question, Jeff. I think the thing that is sometimes a disconnect here is that you saw commercials on TV, and we talked about this, where what's your number? Remember those commercials? What's your number? And these guys were carrying around, $2,750,000, $4 million, $3 million, and people are going, I can never get there.
Yeah.
They should have been carrying it around in a wheelbarrow or something.
And let's face it, we see people from all walks of life, and most people are not going to have $3 and $4 million when they get to retirement. Now, if you are listening to this show and you are a Gen Z or even a late millennial, those numbers may be more attainable because you have more time. But for most of us, mere mortals being baby boomers and Gen Xers, those are really large numbers. I think the first thing we need to do is say, okay, what is it that I really need in retirement to live the way that I want to? Because no matter how much we want something to be so, you remember when you were a little kid, you'd say, well, I don't like that. I want it to be this way.
Yeah.
And your mom and dad would say, well, I'm sorry, that's just not how it works. Well, I don't care. I want it to be.
Sometimes you got to grow up eventually, but some people never grow up. I know what you're saying.
Right. So sometimes we have to really step back and say, okay, what do we really need? And there's a big disconnect in this area, too, because people will say, well, you know what? Here's Martha and George, right? I always use George and Martha Washington. So George makes $75,000 a year at his job, and Martha makes $50,000. So that's $125,000. So we need $125,000 in retirement is what we need to live on, and our assets won't produce that. Well, you've forgotten about, you maybe have a pension, you maybe have Social Security, you have the money that you've saved. Plus, the other thing you have to remember is you're funding maybe a 401k to the tune of maybe 5 or 10% per year, or maybe more than that out of your money now. You're paying Social Security, Medicare, Medicaid of 7+%. You're also paying taxes out of there. So what we really want to look at, number one, let's calculate our expenses. And then number two, let's really see what we're taking to the bank right now today. So when we really start to look at these budgets, sometimes they're much different than people think they are.
Right. Well, if you figure, two Social Securities, let's say George's Social Security is maybe, $2,500 a month for the sake of argument, and Martha's is $2,000 a month right there. There's $4,500. Lucky enough to have a small pension, it's $1,000. That's $5,500 a month. So, if you got that coming in, you're here in the last bastion of sanity, and you're living reasonably, I think $250,000 would probably last fairly long. But again, it depends upon a lot of factors. What do you want to do in retirement? Also, what your expenses are. Is your house going to be paid off? Do you have a car loan? What sort of car do you have? Now, for myself personally, I'll keep a car 6 to 10 years. So again, it just depends. $250,000 for the average person listening to this program today, Randy and Jake, in this part of the country, if they're reasonable, could it really last the rest of their life?
Sure, it can. And the thing we have to look at there is, what is a reasonable amount of withdrawal from your retirement plan? So a lot of people say, well, we can assume that we can make at least 8% return, or maybe some people say 10 in the market, right? Because over the last few years, the market has returned, or the last 30 years or 40 years has returned, the S&P might be 10%. You have to realize that when you look at that, especially if you look at like a mutual fund report or something like that, there's a math problem there. When you enter negative years into an average, it breaks the equation. So when you really look at the hard asset return, sometimes that's much different. Plus, we also have to remember that sequence of returns, when those returns come in and how much money we're spending out of our portfolio each year is going to determine how long it lasts. And many times we've talked about Mr. Green and Mr. Brown, who both retired at 65 with $1 million. They both withdrew $50,000. And at age 83, Mr. Brown was broke and Mr. Green had $3 million. And they were invested the same way. It was just the timing, the sequence of those returns, how they came in year over year, that determined who had all that money and who did not. And those are things we simply cannot control. Because, well, now I forget, Jeff, you can control the stock market, right?
Oh, yeah, sure. I do it every day.
Yeah. So nobody can control those things. So what we have to
right.
do, and we're going to talk about this in the fourth segment, is we really ultimately have to have a plan. And we also have to really be realistic. So sometimes when people come in and sit down with me and say, this is what I really need, sometimes I would say, we should have been here 10 years ago so we could have prepped for this a little better. But for the most part, when people come in, they are realistic, and we can help people retire and stay retired on whatever their amount of money is that they have. But we will use a reasonable amount of withdrawal and a reasonable amount of income that can sustain them for the rest of their days.
So $250,000 in retirement will depend upon your expenses, what they are, estimating rate of return. Also, as you said, a reasonable withdrawal strategy, and that can change over time. But also some other factors to consider would be market volatility, but not the least of which, and I think very important, is going to be longevity, how long you're going to live.
Yeah, sure. Whenever we look at retirement plans, we always assume people are going to live to at least 90, and many times we go to 95 because nobody wants to get to 90 and go, well, Martha, we're out of money. Yeah, we don't want to get there.
Nope.
The thing I would say too that's important for people to know is, you're going to have health issues that are going to come along. You're going to have a roof that leaks. You're going to need emergency funds along the way. So, yeah, there's the 4% rule that's been out there for a very long time. We know that properly structured portfolio, I should say, will really yield and be able to sustain a 5% withdrawal over the long haul. And so as we start looking at how much we can withdraw and how we can keep the roof fixed and keep a car in the driveway and all those things, we know what those numbers are like. And so as we sit down with people and really develop the plan, it will become clear to people because let's face it, we help people retire every day. Most people retire once in a lifetime. And so it's something they don't know all the little nuts and bolts of and how it all comes together, but we can help piece that all together, have good conversations, and finally people go, yeah, I can now see my way clear to how I can retire with the amount of money that I have, and I can see my way going forward through the age 90 or 95.
So in this part of the country, I would imagine that you see a lot of people come into you and they've got $250,000. Are they worried about this? And, realistically, here in the last bastion of sanity, you can probably have a reasonably good lifestyle on $250,000, I would think.
Well, a lot of people would tell you that the scariest thing on earth is they fear running out of money. And a lot of surveys have said that it's something like 68% of people fear that more than death, running out of money. And I'll never forget the lady that, was talking to me in the office. We were having our first conversation, and she said, so do we have to talk about scary money stuff?
I remember that.
That's been a long time ago, but I've never forgotten that, because we were just having small talk. And I said, well, we should probably talk about business. She goes, does that mean we have to talk about scary money stuff? I said, yeah. And so hopefully we can take the scary out of that for you, my dear.
Yeah.
And I think a lot of people, the reason why it's scary to them is because nobody's ever taken the time to explain anything to them, right? When they set up their employer plan when they were 22 years old or whatever, when they first started their career, you go in there, you sign up for the 401k, and it says, hey, I'm an aggressive risk tolerance, so bam, we slap in a whole bunch of mutual funds, and then you don't look at it for 30 years. And I think that nobody really understands. I say nobody. Probably less than 2% of the people I talk to really understand what it is that they have, how long it should last them, what kind of withdrawals to take off their money. And so once we have a conversation or several conversations even to where you get comfortable with your setup, comfortable with your risk tolerance, comfortable with what we're doing, I think that really can take some of the scary out of it if you understand what's going to happen in your portfolio when things are good, when they're bad, what your money manager is thinking in different scenarios, I think a lot of that can give you some direction and help you really, maybe for the first time, understand what it is that your plan is and what it is that you hold.
I've got a home in Tennessee in a retirement type of place. I mean, it's not age restricted, but nevertheless, there are a lot of people. As a matter of fact, most of the people running around here are living off of just 2 Social Security checks and a pension, and they're doing just fine. But that is not going to work, I think, in most parts of the country. But I still think that $250,000 invested properly and with a proper withdrawal rate, I mean, living, not really just, like a miser, but living reasonably comfortable should be something that you can achieve with a plan. Now, that's, I think, the very important part, and we'll talk about this in the next segment, is the importance of having a plan that is an all-inclusive plan, right?
Absolutely. And, I will say this, Jeff. You're right. You may not be able to live in Jupiter, Florida, or you may not be able to live.
Of course not.
But honestly, most people don't live there anyway.
Sure.
And so people are used to living within their means, and I think many times where the biggest disconnect and some of the relief is what I alluded to earlier, where they say, "Man, I feel like I'm making all this money, and in retirement I'm not going to have much money."
Right.
But when we boil it all down and we take all the taxes out and the Social Security and Medicare, Medicaid, you're not going to have to pay and all that. And of course, now in the state of Missouri here, effective 2024, we don't pay taxes on Social Security here anymore. So that's a good thing. That's a little extra leg up that people get. But once we really get underneath it, people go, okay, yeah, I can see how we can make it and we're going to be okay.
Yeah. And I remember my parents, my aunts and uncles and stuff when I was a kid, and they had retired and all they had was a Social Security check, and they were just fine. They didn't seem to want for anything, but then they didn't want that much. I mean, every Sunday during the summertime, we had a picnic, and played some horseshoes and listened to Reds baseball on the radio outside. And that was just fine. And, once a year, take a trip up to Minnesota, do a little fishing. And in July, maybe get in the car and drive down to Florida for a week or so. Could live just fine on just Social Security checks. But times, they are a-changing. So $250,000 in retirement. If you've got that, don't fret. Come and sit down, talk to Randy and Jake. We'll find a way to make that work for you. 417-889-7233 is our telephone number. Once again, 417-889-7233. What's going to happen when you call that number? Well, this weekend you'll leave your name, your telephone number. Ashley will call you back and set up a time for you to come in and sit down and have this very, very casual conversation. It's a no-tie zone at Floyd Financial Group. We're happy to meet you where you are, and we would love to meet you. Again, 417-889-7233. You can find out more about us online at floydfinancialgroup.com. Time for a break, Randy and Jake. When we come back here on Show Me the Money, we'll talk about the number one thing you need in retirement when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about the most important thing in retirement, Jeff, and that is to have a plan.
Yeah, I was going to ask you what it is, but you tipped us off there. A plan is so important. I mean, it doesn't make any difference what you do, whether we're cooking a meal or whether we're going on a trip, whether we're building something. You got to have a plan if you're going to get there successfully. I can't think of many things where you just fly by the seat of your pants. Okay, so we've got a destination. It's going to be retirement. Where do we start with this plan? What sort of roadmap do we get out to begin a successful journey?
Yeah, for sure, Jeff. So, the first thing that we always do when people come to see us and we're having our first, I don't even want to call it an interview, it's our first conversation, because that's really what it is. We want to get to know those people and know what's important to them, learn about their family dynamics, because all of us have different family dynamics, and we've talked about a few of those behind the scenes here today on the show. But, we need to learn about people, what's important to them, and what they're trying to accomplish, and what does retirement really look like for them. I have people, and we've alluded to this before, but we have people that they say, hey, I just want to sit on my back porch, drink coffee, and watch my cattle grow. And then we have people that want to travel the world. I mean, I have a couple of ladies here that they just want to take a trip every month. That's what they want to do. Once a month, they want to go on a trip, come home for a couple of weeks, go out for a couple of weeks, come home for a couple of weeks. And then, we have some people that are more middle of the road. They like to do a little bit of this, a little bit of that. And then we have some people that are similar to me that they like to, ride bikes and do triathlons and run marathons and, do that sort of thing. But retirement's different for everybody. And that's one of the first things we really need to understand about people is what's important to them and what are they trying to accomplish. We call that discovery. And so that's kind of where we start. Secondarily, then, we say, okay, well, how many years have you worked and what's your career like and what kind of money do you make now and what's your budget? We could kind of call that the analysis stage, if you will. Let's see where people are and what they've saved for retirement. And then, from there, we will start to develop a plan based on their unique goals, desires, and family dynamics and, all the money that they've saved and all that. We're going to find out what the best scenario is that fits their specific needs and wants. And then from there, we go into step 3, and that's where we put the plan together. And It's not where we just go, wham, bam, this is the plan. Whether you like it or not, you're going to knuckle under and do it. It doesn't work that way. The plan is something that it's a starting point where we put it together. And then from there, we analyze that and we look at that and then have another discussion with those folks and say, so, this income would come from here, this income would come from here, this is what you're going to have, projected out and how it's going to last. And then we'll have a conversation about maybe some tweaks and changes that they want to make. And they may say, well, we've decided that we're going to think about taking this trip here. We'd like to do this for our kids and, that sort of thing. So all that comes into the planning process of things, if you will. And so this is not a one-meeting scenario either. We cannot possibly do the work that needs to be done and understand what people are needing and wanting and do the plan all in one meeting. So generally, it's a 2 or 3 meeting process for us to even get to where we have the plan all mapped out.
So you got to have a plan, Stan, and don't make a mistake, Jake. I mean, we could write a song about this. Retirement planning here with Randy and Jake Floyd at Floyd Financial Group. So discovery, analysis, planning, implementation, and follow-up. And as you said, this isn't just one meeting. It's a several meeting process. So why are people so afraid, do you think, of making a plan? I mean, are they afraid that the best laid plans can go awry? And I mean, how do we avoid these plans from going off track?
I think a couple of things. I think that as a rule, as we have worked in our career and we've saved money and we've put money into 401ks, 403bs, whatever the plan may be, savings accounts, CDs, just market investments, brokerage accounts, the money's over there, but because we have a steady source of income from work, we know it's there, but it really it isn't a quantity of replacement income that they can put a finger on, right? So it's something we have to really sit down and say, okay, have you looked at Social Security in a while? No. Well, Social Security used to send you a statement every year. Well, now I think you get one every 5 years unless you log in,
Right.
Then you can see it. But most people haven't logged in and don't have a Social Security login, so they're not really sure what that's going to look like. Or if they have looked at it, they looked at it maybe 2 or 3 years ago when they were 55 or 58 or maybe 60, and they haven't looked at it recently. And, with some of the cost of living adjustments we've had, plus just their extra earnings going in, and they're probably in the best earning years of their life, that number sometimes is substantially different than they think it might be. The other thing is then we look at their investments and their Social Security and all their taxable investments versus things that are more tax current to figure out what their tax picture is going to be and see what their actual income is going to look like. So, yeah, it's a multifaceted, more than one time conversation to really get through this thing called retirement.
We're talking with Randy and Jake Floyd, Floyd Financial Group. We're talking about the importance of having a plan. Now, a lot of people try to do their own plan, but there are some gaps that they run into, not the least of which, and we'll talk about basically 3 of them here. Number 1 is going to be insurance planning. As a non-financial advisor, as a non-licensed person, I think there is a limit, is there not, to what you can do insofar as insurance planning goes?
Well, yeah, that would be for sure. So, here we're licensed in pretty much all the disciplines from long-term care to life insurance and, all the investment strategies and things. So we can use any asset class that we need to here and actually put all those together in a correct combination that fits the retirement needs and the healthcare needs and the long-term care potential needs of clients. That doesn't mean we're going to always push people to buy long-term care insurance. Sometimes long-term care insurance is the right move for them. Sometimes it's not. Sometimes people have enough money to where it doesn't make sense to buy long-term care insurance because sometimes they can cash flow it. Other times, the cost of buying a long-term care plan is just not worth it to the client. They just don't want to give up the money. So it's not like we're going to try to force people to do things they don't want to do. That's not what it's about. What it's about is building you a well-rounded retirement plan where we've looked down the road, we've looked at all the potential things that could happen, how those impact you if and when those things happen, to help people, make a good, solid decision that they themselves are comfortable with.
So that is that deficiency. The other is using spreadsheet software for DIYers. I mean, these things like Microsoft Excel, Google Sheets, they can almost never serve as a replacement for financial planning or portfolio analytics tool, right?
Right. I mean, it's too emotional many times, too. People, when they're trying to build their own plan and look at managing their own money, if they aren't careful, they can be pretty knee-jerk reactive. In other words, hey, the market's up today, the market's down. I had a client in here a few weeks ago, and he was saying, well, why don't you put that money in when the market's going up and pull it out when the market's going down? Well, we could do that, but that is a recipe for disaster, because if you're always looking to go in when markets are going up and pull out when markets are going down, you'll very rarely get that timing right, and you'll leave more on the table than it was worth.
And a big hole I think that people run into when they try to DIY their retirement plan is going to be tax planning. I mean, the tax code is so extensive, it's so complicated. I don't see how anyone could possibly do that. And they say, well, yeah, I send my information to my CPA, he does my return. That's not tax planning, that's tax reporting. Planning is looking through the windshield, not the rearview mirror.
Right. And the thing about tax planning, I would say this too, is some people right now are not paying any taxes on their Social Security based on how their retirement plan is working. Some people are paying on 50% of their Social Security, and some are paying on 85%. That's the most of your Social Security that could be taxed. So in other words, if you got $2,000 a month in Social Security, 85% of that would be $17,000, that's the most of that $24,000 a year that could be taxed. Not that you're paying 85% in tax, but crossing those thresholds, sometimes people come and say, well, I'd like to have a little bit more money. The other day I had one, they said, well, we'd like to have some more money. And we looked at giving them another $10,000. And by giving them another $10,000, it put them over and into a tax bracket where they were paying more on their Social Security. And they ended up not realizing very much out of it. And they said, we don't want to do that right now. In fact, we're going to hold back until we absolutely need that extra money for something. And then we'll come to you and figure out how to get it and maybe divide it up into 2 tax years. And so you're right about tax planning. It's one of those things that, and sometimes people come in and say, hey, listen, I want to buy a new car and I want to pull $60,000 out of my IRA. And I say, well, let's analyze that for a moment. Well, I don't want any payments. Well, I'd say, well, let's talk about that for a minute, because there's places out there right now you can go and get 2% car financing, because Detroit and all these manufacturers still have to move that metal, so they're giving us pretty favorable rates on financing. Well, at 2% on $60,000, that's $1,200 in interest if you finance the whole thing. If you take $60,000 out of your retirement account, and let's say you're already at $90,000 or $100,000 in income, all of a sudden now you've paid 25% in taxes, and you've taken the money out that no longer has a chance to earn for you, trying to save $1,200 a year. I'm not sure that works. So there's better ways to go about that. I almost said skin that cat. I assure you, I've never skinned one. But,
just a saying, folks. Yeah, just a saying. Go ahead.
There's a lot of ways to approach buying things, and ultimately what we want to do is, like you said, have an effective tax strategy, help people to not give the government any more money than they have to.
So we've established the number one thing you need to get through retirement, to have a successful retirement, is going to be a plan. So let's talk a little bit about how we get that started. Now, we invite people to call 417-889-7233 this weekend. We do it every weekend. When they call that number and Ashley schedules an appointment for them, what can they expect, Randy or Jake, when people come in? Is this a scary situation? What do they have to bring with them?
Well, Jake can be pretty scary. No,
Can he?
I'm kidding. Honestly, it's one of those things. We're very relaxed in here. We want to be, and we want people to be relaxed. So when you come in, basically, we're going to sit down and just get to know you. You know, if you want some coffee, depending on where you're at, it's pop or soda, depending on where you're from, right? We'll give you some pop or some soda or water, whatever it is you like.
Sure.
We usually keep some candy out there, too, if you need to be sweetened up a little bit to get going.
Most of our listeners are sweet already.
Yeah, that's true. So for the most part, it's just a conversation. Nothing to be afraid of at all. My grandma used to say, you know, Randy, most people pull their pants on just like you do, one leg at a time. And we certainly do here. And there's no highbrows and no judgment here. It's just let's talk, get to know one another, and see if we can help.
That's right. So if you would like your retirement plan with Randy and Jake, you want to get the conversation started, again, this is just a casual conversation. It's like talking to an informed uncle or a brother or something like that, a cousin who's in the business. We'd like to make this invitation to you this week to call 417-889-7233. Make that call this weekend. Why wouldn't you accept this help? You may think that you've got all the answers, but chances are you may not have them all. You may be missing some things that can cost you a lot of money in retirement or compromising your quality of life in a retirement that could last 30-plus years. So take advantage of this opportunity this weekend. Again, no cost, no obligation, and no judgment. 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. Well, Randy and Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank the greatest listeners in the world, ours, right here in the last bastion of sanity, Springfield, Missouri. So for Randy and Jake, I'm Jeff Shade. Have yourself a great September weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.